Hello traders, Igor here, MrTopTick.com. Welcome back to the channel. Today is Friday, March 17th, 2023. I'm going to talk about a position. This is a 112 bear trap, which is a part of an ongoing campaign of bear traps that I put on every single week, typically on a Tuesday or a Wednesday, and then every week on a Friday. I have a position that rolls off, and as I continue to add new trades and older positions are rolling off, I have about 7 to 8 positions in rotation at any given time. Just to give you an update on overall positions that we have put on and took off in the last couple of months. Last couple of weeks, we had really pretty calm markets as far as 112 bear traps go. So this is what our tracking portfolio looks like. So on the 17th, on the 28th of February, then on the 3rd of March, we closed 3 positions. They all expired. Now, they were expired, but there were debits to close. And these debits are a part of harvesting short out of the money puts, meaning when puts that are being sold decay to a point where it no longer makes sense to hold them, I close them out, paying a small debit, so that kind of takes away from the initial credit that I collect. And today I want to talk about a position that is expiring on the 17th today. This also had a harvesting component where I took off the out-of-the-money short puts to eliminate downside risk, and we'll get into that right now. So this is a typical Spx 112 bear trap. This trade was initiated 59 days until expiration. This trade was put on January 17th. And in the last series of 112 bear traps, I was using a 5 lot. I increased size here just a little bit. I was filled on this position in 2 tranches. I put on a 5 lot, and then I added 3 more. All in all, I collected about $9,450 in credits. This position did require quite a bit of margin. I believe for an 8 lot, this position required something close to about $220,000. For those that are following along or are asking questions about buying power and how to drastically reduce that number, there's a number of alternatives that are available. You can use SPY options. You can use ES options. You can use MES options. You can also use XSP options, which are 1/10 the size of SPX. So there are alternatives, but anyone trading in a portfolio margin account, given enough size, this is not a terrible trade to initiate. It does take up buying power, but this trade is very rewarding as long as it is managed properly. I want to step through steps that were taken along the way in this trade, and I want to highlight the first thing. We could look at a chart where we are when we take the trade, right? So we are already starting to kind of rise on the SPX. We have 8 and 21 EMA cross in a bullish formation. We are above 50-day moving average. So overall market is bullish. This trade has a couple of potential outcomes. If we expire above 39.30, we just get to keep credit that we take in up front. If we are inside the bear trap at expiration, which is between the out-of-the-money shorts, which are at 33.80, and if we are inside of our put debit spread, which is at 3,900, we not only get to keep the initial credit that we take in upon entry, but we also make a full trap profit, which is the width of the put debit spread. In this case, my put debit spread was 30 points wide, and this is where this trade makes the most potential profit. The big trouble is if the underlying goes way down and no management is taking place, this position could get ugly and run into trouble really, really quick. And we can go forward just a couple of days. And I believe once we put this trade on, about 2 days later, the market dipped just a bit. So this is 1 day in the trade. This is 2 days in the trade, right? So 2 days later, the market has moved 2.4 standard deviations from where we initiated this trade. And you can see that even though we are moving in the right direction, we're moving towards the trap, because this is where we want to capture price inside of our put debit spread, in somewhere above our short out of the money naked puts. But because this is so early in the trade, there are still 57 days until expiration. This obviously based on our T+0 curve, right? This is our P&L today. This line here is our P&L at expiration. So if we were here at 3,900 at expiration, this trade is very profitable. But because we're at 3,900, but only 2 days after we initiated the trade, and we still have 57 days to hold, this trade is obviously showing a slight loss. Now, on the way down, I do have a set of rules where certain management techniques need to be deployed in order to slow things down on the way down and just kind of give ourselves a chance for the market to possibly revert. And more importantly, when volatility starts to increase on the way down, this also pushes our T+0 line down. That could potentially be a problem. So on the way down, we just need to slow things down. We need to fix our T+0 line in a way that it'll give us enough time to potentially see price revert back to the mean or head back to where it started, and this position will auto correct. So this was 2 days later. As we can see, we're at a slight loss. There's really nothing to worry about just yet. And I'm going to go forward a few more days. Let's go forward a week. So now a week later, right, S&P now about 160 points higher than where we were 1 week prior to this day. This is January 26th. And this position is showing a pretty decent profit. You know, the max potential reward here above the bear trap is, let's call this a 94.50. We're at 45.30. So we're at about halfway to our max potential reward in about 9 days. Now, we did nothing else to this trade until about 30 days in the trade or so. So I'm going to go forward to where we needed to make our first move. So here we are. This is 41 days since we put this trade on. As we can see that in the 41 days, the market has moved barely, right? We're at about the same level where we were when we took the trade. So when we took the trade, S&P was at around 4,003, and 41 days later, we're at 4,009. So we're right about where we started. And as you can see, now this trade is showing a much bigger profit than what the profit will be at expiration. And this is due to two things working for us. Number one, out of the money short puts are decaying. A lot of its value has already gone. And then we also have a put debit spread that's not too far away. You know, this put debit spread is only about maybe 3% out of the money. With 18 days to go, there's still a good chance that the price may hop somewhere under 3,900, and this put debit spread is going to end up in the money. So the value of the put debit spread is increasing. This is good for us because we are long a put debit spread, and the value of the short far out of the money puts, right at 33.80, decreasing. We're short those puts, so that's working for us as well, and that is why we are seeing a P&L which is greater than what the P&L at expiration is going to look like. Now here, I decided to make my first move. I went ahead and I looked at the value of my short out of the money puts. We see they're trading for about 95 cents. And we can look at what we originally sold. So we sold these puts for $10.18. They're trading right around $1 debit. So safe to say that 90% of the value of these puts has already decayed. We have 3 more weeks until expiration. So what I decided to do, I decided to go ahead and buy to close these puts. And this is going to put me in a position where I'm paying a debit, right? So I am decreasing my max potential reward, right? I'm paying from the credit that I collected. Originally, I collected $9,450. If I'm going to buy these puts to close, that's going to reduce my credit from $94.50 to about $79.30. And that's the negative, right? But the positive here is that if the market does pull back 3% over the next 18 days, I stand to make a substantially higher return with no downside risk. So that's the positive. Also, this is the harvesting part that I was talking about earlier, right? When I take off these puts earlier before expiration, I also unlock a ton of buying power here, which frees up buying power for newer positions to be put on. And I think this is a very important part of management of a number of these trades, right? If you just put one on and you wait until it expires before you put the next position on, it doesn't really make a big difference. But if you have a number of positions on, or you're looking to add more positions, holding these short out of the money puts for the last 95 cents doesn't really make a lot of sense. So I take these off. This opens up all the buying power here, and I can use it to put new trades, or I could hold it as reserves just in case things start to get funny. So what I did here, I went ahead and I bought to close 16 of these puts. I paid $1 per contract to close these puts, and this left me in a position where over the next 18 days, if S&P is above 39.30, I'll make just about $8,000. $78.50 is what this software is showing me. And if S&P is below 3,900, this 30-point wide put debit spread is going to be in the money, worth 30 points or $3,000 per one spread, plus whatever credit I have here, which is, let's call this $8,000. So we go forward, and this is just a couple of days later. This is March 1st. We could take a look at a price chart, and we can see that, this is where we took the trade. The market ran up, kind of consolidated to slightly lower, and now we have 8 and 21 EMA cross bearish. We're also below 50-day moving average. From here, I'm thinking a couple of things. If 3,900 doesn't hold, there's a very good chance we can come back down into this zone or this consolidation area where we were late last year. So I'm okay holding. I don't have to worry about this position. I don't even have to think about it, because what's going to happen is if the market rallies, no big deal. If the market falls, I'll make more money with no downside risk. But because the market is overall in an uptrend, right, we can see that we're making a series of higher highs and higher lows. I'm assuming that this could potentially be a low. What I decided to do, I decided to take half of my position off. I've decided to close half of my put debit spreads, and this is what this position looked like before I took half of these put debit spreads. I closed these put debit spreads for $10.80 credit. So I further increased my max potential reward in case S&P does end above 39.30. And this was at expense of lowering my potential reward if S&P is below 3,900 at expiration, right? So there's always the good and the bad. What is the good? The good is I'm increasing my potential reward above 39.30. But the bad is I am decreasing my max potential reward under 3,900. Again, we can take a look at what this looks like right? So before making my adjustment under 3,900, this position could make $32,000. Since I took half of these puts off, now at 3,900 or lower, this position isn't going to make $32,000. This position has a max potential reward of about 24, just over $24,000. Here we are today. S&P is currently trading at 3906. So we're kind of not here nor there, right? This trade is currently showing a profit of about $19,310. If I hold until expiration today, this is a cash settled vehicle, so I don't have to worry about broker forcing a close of this trade before the bell to avoid assignment and so on. So I can hold this, and after the close, this trade is going to be settled for cash. We have 39.30, which is in the money by about 24 points. And we have a 3,900, which is out of the money and will potentially be worth nothing if S&P remains above 3,900. Now, in order to avoid all the drama, or if I wanted to get out of this trade and not think about it anymore, I can just go ahead, queue up my closing order. This spread is currently going for $18.20. So I can close out this trade, not wait until 4 o'clock today, or if I think the market may roll over and continue to push lower into the end of the day, as long as S&P is below 3,900, this remaining spread is going to be worth 30 points, which is $3,000 per one lot. We have 4 of these spreads on, so that's $12,000, plus we have already collected $12,170. So this trade under 39.30 has a max potential reward for about $24,170 or so. So that's the trade. I hope that you guys picked up something new. If you have any questions, leave them in the comments. As always, take care of the risk. The profits will take care of themselves, and we'll see you in the next one.